Hi there, welcome back to Stock Trading for Beginner series. We are on to topic 2. Today I'll be covering technical analysis mainly around chart patterns and trends. I have created a playlist for ease. I'll keep adding as and when I publish new videos. Before that, a quick recap so you get some continuity and things make sense in case you're new here or you haven't watched my previous videos. Stock analysis is an essential part of trading, you know that. It involves evaluating market data from past and present to make informed decisions about buying and selling a stock. There are two main types of stock analysis. Fundamental analysis, which focuses on evaluating the market economic environment of a company, assessing the financial reports, business performance, quality of a company, all of that to deduce the fair value or intrinsic value of a stock. While technical analysis is a study of price charts and trends using technical indicators to predict future price movements of a stock. It is independent of any fundamentals of a stock and purely focuses on past and present price movements and market patterns to predict a stock's future behavior. Now, in investing, we say don't time the market, as the goal there is to buy and hold for long term. However, in trading, timing is everything. Suppose you have a list of stocks with great fundamentals you want to trade, but how do you determine your entry point? And that is where technical analysis plays a pivotal role. It basically aids in spotting potential trading opportunities. So fundamental analysis tells you what to buy, while technical analysis indicates when to buy, the best time to enter or exit the market. I've already covered fundamental analysis in an earlier video. I'll leave a link down below. In today's video, we'll be focusing exclusively on technical analysis, mainly price charts and trends. A little bit more about technical analysis. Technical analysis is based on the premise that the price of a stock moves in trends and therefore historic price movements tend to repeat themselves. There are three basic components to a technical analysis: price charts, trends, and indicators. Today's topic is on price charts and market trends. I'll cover technical indicators in future videos. So let's crack on. A price chart shows the price movement of a particular stock over a period of time. Let's look at a real-life example. Here is the price chart for Amazon. Every price chart needs a time frame. The time frame can range from 1 second all the way up to a month, depending on the trading application you use. The most popular time frames are 5 minutes, 15 minutes, and daily charts. Here we are looking at a daily price chart. Short-term traders, such as scalp or intraday traders, tend to use shorter time frames, such as 5 or 15 minutes chart, while long-term traders, such as swing or position traders, favor hourly or daily charts. There are three main types of charts: line chart, bar chart, and candlestick chart. What you're seeing here is a candlestick chart. More on that later. Now, all three show the price movement, but in different formats. Some have limited information, while others are slightly more comprehensive. Let's first look at the line chart. Let's change the price of the chart here for Amazon to line chart like so. As you can see, a line chart is a straight line that connects the price of a stock between various time frames, typically only connecting the closing price of one time period to another. Here you can see the line connects the closing price each day between Feb and April of this year. That's basically what a line chart is. Moving on to second type of chart, that is bar chart, also known as HLOC. H stands for high, L for low, O for opening price, and C for closing price. Now let's change our chart to HLOC here. This is a slightly more detailed than a simple line chart, in that it displays the open, close, high, and low price for each time period. Now if we zoom in slightly, the very top of the bar shows the highest price, while the bottom shows the lowest. The horizontal dash to the left is the opening price, and one to the right is the closing price, something like this. So that is essentially a bar chart. And the last chart is a candlestick chart. Let's change it back to candlestick like we had before. This is similar to a bar chart but shows price information slightly differently. It's the more comprehensive of the three charts. Here you have a body and the two wicks, upper and lower wicks. For example, on a daily candlestick chart like this, the body represents open and close price range for that day. The top wick represents the highest price and bottom wick shows the lowest price for that day. To be more precise, this candle here shows on the 11th of April, the stock opened at 102.15. It hit a lowest price of 99.01, which is lowest point of the wick, and then went all the way up to 102.65, which is the highest point of the wick before closing at 99.96. Unlike other two charts, candlesticks charts are mostly shown in two colors, green and red. A red candle signifies the stock is closed below the opening price, like in this case, and a green candle signifies the stock is closed above the opening price for a specific time period, like in this one. Candlestick charts are the most popular of the charts amongst traders as they provide a lot of meaningful price action strategies than the other two types. For instance, a green candle represents bullish sentiment, while a red candle signifies the market is bearish. Furthermore, the shape of each candlestick can also provide useful information with regards to buying and selling pressure. If a candlestick has a long green body like this here, it means there's a lot of buying pressure, while a long red candle can mean the selling pressure is really high. Since candlestick charts are loaded with intricate details of price action, they are considered the most favorable of the charts for trading. That brings us to the next point on how to identify chart patterns and trends and make trading decisions. First, let's look at the market trends. You must have heard of the expression, the trend is your friend. When you look at a price chart, it's a series of zigzags, highs and lows over a period of time. Price usually moves in one direction or the other, creating a trend. Trend in technical analysis is just the direction of the price movement. Identifying a trend can give you potential signals to enter or exit the market. There are three types of price trends: uptrend, downtrend, and sideways. In an uptrend, like in this chart, the stock price makes consistent higher highs and higher lows over a period of time. This trend is referred to as uptrend. But the question is, when do you enter the market in an uptrend? It is important to enter during a pullback, ideally in this area where traders would look to enter. But the pullback can sometimes break the trend and go in an opposite direction, like in this instance. Here, the pullback breaks the previous lows, signaling a reverse trend. In this instance, you would want to hold off from buying until the market shows a positive trend and moves upwards. In a downtrend, the price moves in an opposite direction, making consistent lower highs and lower lows. This trend is favorable if you are shorting, where you would sell high and buy low. Also, this trend can indicate profit taking if you had bought lower previously. Once again, the downtrend is said to continue until it breaks the previous highs, after which the trend is likely to change its direction. And the last type of trend is a sideways trend. Here, the price sort of oscillates in a very narrow range without forming any clear pattern. So that's about the types of trends. Next, let's look at how to plot trends on a chart. It's fairly simple to plot a trend on a chart. You do that by connecting the peaks or troughs in a line like so. A trend line that connects the higher low points indicates an uptrend. These higher low points are an area of support, implying buying opportunities. Now let's look at a trend line that connects lower highs, which acts as a resistance, giving traders an opportunity to sell. This indicates a downtrend. A very important aspect of drawing a trend line is that you need at least 2 points to start a trend, but it takes 3 to confirm the trend. So in this chart, as soon as the third level is established, we can expect a bullish price action. Otherwise, you might risk a trend reversal. Above all, the most important part of drawing a trend line is not to force it. The most reliable trend lines are the most obvious ones. If you have to force it, it's probably not worth it. And finally, bear in mind that if trend lines are steeper, they tend to be unreliable as they can break easily. Next, let's look at support and resistance levels. Support and resistance are levels where forces of demand and supply meet to force the price movement in one direction. The best analogy to describe would be support is like a floor while resistance is like a ceiling, creating a channel that restricts the price movement. Support is a level at which demand is strong enough to stop the stock from falling any further. Here in this example, you can see how each time the price reaches the support level, it bounces back up. This is called testing the level. It simply means more buyers are inclined to buy at this level and sellers are less willing to sell, creating more demand and less supply, causing the price to bounce up. Resistance, on the other hand, is the level at which supply is strong enough to stop the stock from moving higher. Here you can see how each time the price approaches the resistance level, it falls back. This implies more sellers are inclined to sell and buyers are not interested in buying, creating more supply over demand, causing the price to fall back from resistance. The more times the market tests the support or resistance level, the stronger the level is said to be. So a trader, for instance, may choose to buy some shares the next time it falls to this price, predicting the pattern may repeat itself. Conversely, a trader may choose to open a short position the next time the price hits the resistance level, predicting a fall. While these strong levels of support and resistance can create psychological barriers in traders, forcing them to buy or sell, it should be noted that these levels are not always exact. So you may see a support and a resistance channel for a specific time period, after which it's bound to move either higher than the resistance or lower than the support. Now this ties back to the market trend we looked at earlier. So if the market is in an uptrend, it will break the previous resistance level, creating a new resistance. The previous resistance will now likely become the new support level. Similarly, in a downtrend, as the price moves below the prior support level, creating a new support, this becomes new resistance. Moving on, chart patterns. Now that you have a basic idea of what market trends are, what support and resistance look like, next step is to identify chart patterns to predict the price movements more accurately. So what are chart patterns? Chart patterns can identify possible price reversals, provide indication on market sentiments, and also help identify best entry and exit points. There are a plethora of chart patterns out there, but for beginners, less is more. Let's look at the two basic types of chart patterns you should know as a beginner trader: continuation and reversal. Continuation chart patterns are chart formations that signal consolidation. In simple terms, price action here is sideways until it regains momentum. Let's look at some of the common ones in a bit more depth. Triangles, rectangles, wedges, and flags. A triangle occurs when the price moves sideways to form a triangle, like so. A triangle could be an ascending triangle, like the one here, where the price makes higher lows but fails to make higher highs due to strong resistance. Mostly ascending triangles signal a bullish trend, so traders watch out for an impending breakout above the resistance to make a move. In a descending triangle, however, like the one here, price is seen moving lower, making lower highs while holding the support level. A descending triangle generally signals a bearish trend, so more traders are seen gradually entering the market to establish a short position should the price break the level of support. And the last one is a symmetrical triangle. Here, the price moves sideways, creating higher lows and lower highs with no clear indication on which way the market could move. So it could move either to the upside or to the downside. The next type of chart pattern is rectangles. In a rectangle pattern, the price moves sideways to form a rectangle like so. mostly within the support and resistance channel. Here, bears and bulls are equally strong. There are two types. A bullish rectangle, when price moves within the support and resistance but could break out above the resistance, signaling a bullish trend. And a bearish rectangle is when price moves within the support and resistance but could break this support, signaling a bearish trend. Next, let's look at wedges. Here the price moves in a tight range between two trend lines, either upwards or downwards. A rising wedge is formed when a previous uptrend starts to move in a tight range, forming a wedge, signaling a reversal, and the price is likely to push lower. And a falling wedge is formed when a previous downtrend starts to move in a tight range, forming a wedge signaling a bullish trend, and the price is likely to rise. The last continuation pattern is a flag. A flagpole pattern is formed when the price is moving strongly in one direction and then there is a period of retracement before resuming. You can see here how it resembles a flagpole. There are two types. A bull flag. This here is a bull flag formed when the market, which has been rallying upwards, is seeing some consolidation due to profit taking before it resumes its rally. This suggests that there is still buying pressure in the market and could be a good entry point if you're looking to buy. A bear flag is formed when the market, which has been tanking, is seeing some consolidation before it resumes its move downwards. This suggests there is still selling pressure in the market and could be a good entry point if you are shorting. Next type of chart pattern is the reversal chart pattern. These chart formations signal a reversal in price movement. In other words, if a reversal pattern is formed during an uptrend, this can signal a price reversal to the downside. Similarly, if a reversal pattern is formed during a downtrend, this can signal a price reversal to the upside. The most common reversal patterns are double top, double bottom, head and shoulders, and inverse head and shoulders. A double top is formed when the market trending upwards has made two unsuccessful attempts to break through the resistance level, like so. This is top 1 and here is top 2, and this is called the neckline. It often looks like the letter M. So after two failed attempts, the price here is seen making a reversal to the downside. Traders take this as a signal to possibly go short. A double bottom is the exact opposite. Here the market makes two unsuccessful attempts to break support level like so. This is bottom 1 and here is bottom 2 and here is the neckline. It often looks like the letter W. So in this case, after two failed attempts to break the support level, the market here is seen making a reversal to the upside. Now traders take this as a signal to buy. Right, the next reversal pattern is head and shoulders. This pattern is formed when there is a peak, which is the first shoulder, followed by a higher peak, which is the head, and then followed by a lower peak, which looks like the second shoulder. A neckline is formed between the lows on either side of the head. This pattern can signal a downtrend if the neckline is broken. This is the point where traders could look to go short. Now the inverse head and shoulder is the opposite. The first pullback, which is the first shoulder, is followed by a lower pullback, which forms the head, and then another pullback at the same level as the first shoulder, forming the second shoulder, before moving upwards. And here is the neckline. When this is broken, this pattern signals an uptrend, providing a possible opportunity for traders to go long. With that, we have come to the end of today's topic. While learning to identify chart patterns and trends can help you a great deal in trading, as they offer clues about what the market is likely to do next, it should be noted that they are by no means foolproof. They can even produce false signals sometimes. If only you could predict markets accurately, everyone would be minting money. But sadly, that's not the case. Chart patterns are definitely useful to build your own strategy in tandem with other technical indicators. But remember to always backtest your strategies before using them in live trading. I hope you found this useful. See you in the next one. Take care.